All right, so Warren Buffett is sitting on $397 billion in cash right now, and he's still selling. So if you hold stocks, have a 401k, a retirement portfolio, even if you hold gold or silver, this should concern you. And look, the reason he's sitting on so much cash is simple. Because he says there's nothing worth buying. And he has said this 3 times throughout his entire career, and every time it's preceded a major crash. A crash where Warren Buffett was able to pick up the stocks he wanted for pennies on the dollar. So Buffett thinks this time is near. I think this time is near. But I'm still buying. I mean, look, I agree with Warren Buffett, but I'm buying anyway. I'm buying a select few things. So today we're going to talk about what I'm buying, why I'm buying, and why I think the collapse may have already started. If you don't know me, my name's Nick. I've been a professional investor and unprofessional trader for 25 years. None of this is financial advice, and this is not an inducement to buy or sell any assets. And as always, do not take financial advice from some random dude on YouTube. And if you're wondering, yeah, this is a new channel. I have a metals channel. This channel is for stocks and other market stuff. So let's talk about this number, $397 billion. What's it actually mean? Well, we need to talk about what Berkshire Hathaway is. Berkshire is Buffett's company. He's retired as the CEO, but it's still very much his company. And the only thing that company does, it exists to buy stocks and other businesses. It's kind of like a holding company. And that's the whole point of it. It's just a machine for owning companies and stocks. And yet it's the 16th biggest company in the world by market cap, which is absolutely insane when you think about it. Because every other company on that top company list, it actually produces something or it offers some sort of service. Berkshire Hathaway is 16th, and all it does is buy other companies and stocks. I mean, actually, SpaceX, that actually doesn't do anything anyway, and its numbers, sorry, I had to. Anyway, so right now, Berkshire Hathaway is 59% in cash. So more than half of the entire machine is parked in boring government T-bills, doing nothing. And that's never happened. It's in its entire 60-year history. Not in the dot-com bubble mania, not in 2007, although Buffett was heavily cashed up during those periods because he saw those coming, so he was cashed up, but not to this level. So the man who spent his entire life buying companies suddenly doesn't want to buy companies anymore. Even with $397 billion burning a hole in his pocket, he's looking at the market, he's looking at the S&P 500, NASDAQ, all of it, and he's saying, nah, not at these prices. And that's, I guess, where people get Buffett wrong. I mean, Buffett, he isn't really calling for a crash right now. He's just saying everything's too expensive to buy, and he's not buying stuff when it's that expensive. Because Buffett doesn't call crashes. He said, well, he has once. We're going to talk about that time. But anyway, he said himself over and over that he's rubbish at timing the market, and he knows it. What he's brilliant at, though, is price. He just won't ever overpay for anything. So his most famous rule is 6 words long: be fearful when others are greedy. And right now, everyone is greedy. I mean, obviously everyone is greedy. The whole market is drunk on AI, piling in, dead certain that AI is only going up, it's going to take over everyone's jobs, blah, 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 all that nonsense. And they have the audacity to say that Buffett has fumbled the bag, that he's made a big mistake, which is hilarious. And I'm going to get to why everyone's wrong about this in a minute or two. But first, why does he think everything is too expensive? There's a thing called the equity risk premium. So this is just the extra reward you get for taking the risk of owning stocks instead of sitting in safe cash. Think about it like this, right? So cash is safe. A government T-bill, you basically can't lose. It's backed up by the government, etc., unless they, whatever. So stocks are risky. They can fall 50% and ruin your whole decade. So stocks have to pay you more than cash. Otherwise, why would you ever take the risk of holding a stock, right? And that little bit extra on top is your reward for being brave, for holding stocks. So for most of history, that reward has actually been pretty decent. Owning stocks paid you a good chunk more than just parking your money in cash. So you took the extra risk. It made sense. But today things are different. A T-bill, which is basically just lending your money to the US government for a few months or a few years sometimes, it pays you about 3.8% right now, risk-free, guaranteed. And the S&P 500 at today's crazy prices, it pays you about 3 to 4% on some measures. It's actually less than a T-bill sometimes. So let me explain this in a different way, actually. When I was coming up in finance, I was very lucky to have some really good mentors that taught me a lot about finance. So I've decided to pass it on. This is not me trying to sell you mentoring, by the way. I'm just saying I decided to pass it on. I mentor a lot of people, younger people, 20-year-old guys for free. So I've mentored a lot of people over the years. And this is the way I explain equity risk premium to them. So imagine someone offers you a rental flat that pays you 3% a year in rent, but the tenant might trash the place and the building might halve in value, right? And right next to it, there's a bank that offers you an account paying 3.8% guaranteed. No tenants, no risk of devaluation of the building. I mean, to be fair, it is still risky because you're giving your money to the bank and they're all crooks, but you get what I mean. So that's the choice sitting in front of Buffett right now. The whole stock market is that dodgy rental flat, and the T-bills is the safe savings account, and that's why he's all cashed up in T-bills. Now, remember how I said that the equity risk premium is almost always positive for stocks, for holding stocks? Well, the times it isn't is generally when the market is about to collapse. That's when it gets this thin. In the year 2000, that was one of the times. In 2007, that was another time. In 2000, the NASDAQ lost nearly 80%, and it took 15 years to get back up to where it was, which is crazy. In 2008, the whole market roughly halved. And it makes sense when you think about why. When stocks barely pay you more than a safe T-bill, the only thing holding them up is hope. It's hopium, right? The belief that prices are just going to keep climbing forever. Take that hope away, even for a moment, and why would anyone risk sitting in shares for the same return that cash gives them with none of the risk? I mean, they wouldn't. It's illogical. So when enough people stop being stupid and realize that, then they all run for the exit at once. Now, you're probably thinking, Nick, the market's at all-time highs. It's completely fine. It looks all good to me. And you're right. It does look fine. But that's the trick with markets, because the market isn't really the market anymore. And let me show you what I mean. The S&P 500 is supposed to be 500 companies. Nice and spread out, diversified risk, like they always tell you, right? But it isn't. Not really. Nvidia on its own is worth nearly $5 trillion. Apple is about 4.4 trillion. Google is 4.2 trillion. Then you got Microsoft, Amazon, Broadcom, Tesla, Meta, all piled on top, and SpaceX now too, actually. So just that little handful of names is worth well over 20 trillion. And that's more than a third of the entire S&P 500 index, sitting in about 7 or 8 or 9 tech giants. And all of these companies have one thing in common. They are AI tech companies, or AI related, or tangent to AI, except for Apple, to be fair. Apple doesn't get too much into AI. But anyway, and they are all near all-time highs right now, and they just keep pumping. But here's the thing that nobody really tells you. Most of the other 490 odd companies in the index aren't anywhere near their all-time highs. So I need you to think about this for a second. The S&P 500 is an index that tracks the top 500 companies. The S&P 500 keeps on pumping. 490 of those companies are underperforming. 10 are performing so bloody well that they are dragging the other 500 up with them. The 10 are all based on the AI trade, or at least most of them are, 90% of them are. Do you see the problem? I mean, Buffett does. That's why he's not buying. Now, you got some kids that are going to say that Buffett is wrong, that he fumbled the bag, blah, 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 blah. And I get that. Like I said, I mentor some younger kids in their 20s, and they've been saying this to me, but I get it. They're young, they don't know any better. And I've told this story before, but it's a great story, so indulge me. July of 1999, Allen and Company is throwing its annual conference up in Sun Valley, Idaho. It's like the most exclusive billionaire summer camp on earth. The CEOs of every Dotcom darling you've ever heard of are sitting in one room together. Now, Bezos and Gates, those are ones you've heard of, but there was also a lot of other billionaires there that you've probably never heard of, because shortly after this event, their company collapsed. And during the event, they were laughing at Buffett, calling him an idiot. But I can see why they thought he was an idiot. I mean, they have just had the best year of their lives. The NASDAQ is up 86% in 1999. It really felt like the party would never end. The dot-com bubble wasn't a bubble. It was just a ticket to the moon. Then Warren Buffett walks on stage and he gives like the best speech of all time. He tells a room full of tech billionaires that the party is over. He tells them that their valuation makes no sense at all. He pulls up a chart of the car industry. There were 70 car manufacturers in America at the start of the 20th century, he says. How many are left now? 2, maybe 3. Then he asks about airlines. 300 airline companies got started in the early days of aviation. How many are left? Just a handful. The rest went to 0. And he basically told the whole room, you guys are about to become airplane companies or train companies. And the room laughs at him. The press laughs at him. Barron's actually puts him on the cover and they say, what's wrong with Warren Buffett? Or what's wrong, Warren, I think they said. So as if that's the 68-year-old Warren Buffett had gone soft. Like he couldn't keep up with the new economy, couldn't keep up with the internet. 8 months later, the NASDAQ starts collapsing. It loses 78% of its value over the next 2 years. Most of those tech companies in that room at the time that were laughing at Buffett, they go bankrupt. And Buffett, Berkshire, their stock went up 28% that year. That NASDAQ fell, like however much. So he didn't predict the exact week. He didn't try to time the top. He just looked at the maths and said, I don't think this can continue. So he sat it out. And people were making fun of him, but he was right, just like he's doing now. So yeah, when people tell me that I'm an idiot and I should be going all in on SpaceX or any other AI crap, I can accept the feedback. Maybe I am an idiot, but when they say the same thing about Warren Buffett, I think they should simply look back at history at every time Buffett has said the same thing. Every time people have laughed at him, and then they realize that they should have been laughing at themselves because they're the dumb ones. But look, the market needs dummies, right? Somebody has to keep buying the top. Somebody has to hand their wages over every month so the people who got in early have someone to sell their stocks to. In the markets, we call this being exit liquidity, right? So if you're a dummy, you're exit liquidity. And right now, that somebody is, well, I hope it's not you. I mean, is it? Are you buying AI stocks? And look, I'm being a bit unfair though. Look, I don't want to call you a dummy, and if it is you, right? The thing is, the game is rigged. They convince you to keep buying because they need someone to sell to. That's the whole scam of the markets. So you're only a dummy if you keep falling for it once you know about it. But the question is, what do we do about it? What do you and I do about it? Now, Buffett's answer is to go all in on cash. He's hiding in T-bills right now. And for him, that's a perfectly good move. But I'm not doing what Buffett's doing, and I want to explain why. Look, cash doesn't keep you safe, not really, not the way people think it does. The T-bills that Warren Buffett's in, they pay 3.8% or whatever. That sounds great, but inflation right now is running around about 4.2%. So if you do the math, 3.8 minus 4.2, you're going backwards by about 0.4% every single year. Your money is sitting there looking perfectly safe while it's quietly buying you less and less. So even Buffett's hiding place is leaking value. The difference is, it's Buffett. He can afford to. I mean, he's got $397 billion, earning like what, $12 billion in interest per year as he waits. He can sit there for a decade, although he is getting old. But you get what I mean. And look, there's a bigger reason that he can wait. When the crash finally comes, Buffett gets that phone call that me or you never get. I mean, if you go back to 2008, while everyone was panicking, Goldman Sachs came to him desperate for cash. He handed them over $5 billion. They paid him 10% a year on it, guaranteed, plus the right to buy another $5 billion of their shares on the cheap. That is the kind of deal that you only get if you're Warren Buffett, right? If you're sitting on a mountain of cash in a crisis. Me and you, we don't get that deal. I mean, we get the opposite, actually. When a bank goes bankrupt, they get bailed out by our tax dollars, and then they pay us nothing for the privilege. Criminals. Anyway, that's the trap right now, yeah? So the market is way too risky. Being in cash is a lot safer than holding SPX, generally speaking, mathematically speaking. Remember the equity risk premium. But then holding cash, even in the form of T-bills, you're losing money due to inflation. So what am I doing? Well, look, I didn't sell all my stocks, but I did stop owning the most dangerous versions of this market. I stopped being the exit liquidity for Goldman Sachs, for JP Morgan, or for Morgan Stanley and crew. Now let's talk about how I'm doing that. Actually, first, let me quickly tell you the case against what I've just been saying, because I want you to hear both sides of the argument. I don't like just presenting one viewpoint. I need to present the alternate viewpoint where I'm wrong and Buffett is wrong. So the obvious one is first, Nick, if the markets are this overpriced, why hasn't it crashed yet? That's a very good question. So the honest answer is that the signal has been flashing for a while, and the market just keeps ripping away. Although, right as I'm recording this, actually, the market is tanking a little bit. But anyway, tech's been selling off for a few weeks and chip stocks are getting hammered. So this could be the start of something, but it could also be nothing. The gap between stocks and cash can stay thin for years before anything actually breaks. And that's the truth. So if you're planning to dump everything tomorrow, expecting a crash on Friday, don't do that. That's not what I'm saying. Nobody can time this, not me, not Buffett. I'm not giving you a date. I'm just telling you where I think the risk is right now. But also, you don't have to hold this stuff to make money. That's the thing, right? You don't have to hold the riskiest asset that exists right now in order to make money. There's a lot of less risky stuff that you can hold, which I'll talk about in a minute. But I need to talk to you about one more thing first, and then we'll get to the good part. My second point, and I have to be fair here, Berkshire isn't completely frozen. A few weeks back, they did put $10 billion into Google, chasing the AI boom. But see, that wasn't Warren Buffett. That was Greg Abel, the new guy running the show, now that Buffett is retired as chairman. So Greg Abel is running things a little bit differently. Even the press is saying that he's loosening the purse strings now that Buffett has stopped calling the shots. And, that's up to him. He might be right. But think about what that actually tells you. Buffett built a $397 billion cash pile, and then he sat on his hands. The moment he steps back, the new guy piles into AI at the top. I don't know, but still, $10 billion out of $397 billion is what, like 2%, 2.5%, if I'm doing the math right. And this is the other thing we need to talk about. People always say to me, Nick, are you just telling me to sell all my stocks and sit there scared? No, that's not what I'm doing at all. Owning no stocks is also a way to lose. It's a way to fall behind. And your cash just quietly rots away with inflation, like I said. So I'm not saying own nothing. I'm saying own the things that could make money without being super, super risky like AI. And stop overpaying for the popular ones. Stop overpaying for shit like SpaceX. I mean, I started this video by saying that I'm buying, and I am. I'm just not buying the overvalued crap that Warren Buffett is steering away from, and that I really believe everyone should steer away from. So let me explain this. Everyone's always chasing the top company because those are the ones that everyone hears about all the time. Nvidia, SpaceX. But see, that's the trick, guys. The stock market used to be based on true value. A company had to actually make money in order for it to be worth anything. But these days, that just doesn't apply anymore. All you need is a good story and God-tier marketing. Every time you hear Nvidia and SpaceX, you are being marketed to. Every time Sam Altman or some other AI CEO clown gets up on stage and says AI is going to replace everyone's job, that is not the truth. That is marketing. They are using fear about job losses to sell you AI as a product, to sell you their upcoming stock IPO. It's all bullshit. And it's all overpriced. It's garbage. At least with the last big tech bubble, Microsoft and Cisco, they were overpriced, but they were real companies. They actually made something of value. And even then, and I know I say this all the time, but I'm going to go over this again. It took them a long time to recover after the dot-com crash. From the top of the year 2000 dot-com bubble, Microsoft crashed and it didn't recapture that all-time high until 2017, 17 years. Cisco, one of the biggest companies in the world at the time, crashed in the year 2000, did not recover its all-time high until 2026, this year. 26 years for companies that were overvalued but actually built something of value, unlike today's companies. AI, on the other hand, I can see why Warren Buffett is reluctant to buy this shit. So what am I actually doing with my own money? First, like Buffett, I'm holding a decent amount of cash right now. Now, look, I'm not a big fan of holding cash, but I do it short-term, strategically. I said a few months ago on my other channel that I'm starting to cash up right now, and it's ended up working out really well for me because the dollar is currently at a one-year high. And look, this isn't me bragging. I make plenty of bad moves too. This was just one of the moves that worked out. But the good thing about cash is it gives you dry powder to buy bargains when they finally come. So I'm sitting on about 32% cash right now of my entire portfolio. Second, I obviously own a fair bit of metals like gold and silver, a bit of copper, not a lot of copper. I'm going to build my copper position over the next few years. Some uranium, gold and silver miners. That's around about 35% of my portfolio right now. I'm pretty heavy on metals. So what am I doing with the final 30 or so percent? Well, I hold a bit of stocks but not the Mag 7, not AI stocks. Actually, for the most part, it's not even many US stocks. I hold WIG. WIG is Poland's main stock market index. Think about it as the S&P 500 of Poland. People laughed at me when I first got into it, but it's up 12% this year versus SPX is 7%. So, the joke's on them. Then I'm also looking at energy stocks right now. I am bullish on energy because the way I see the world going, we're just going to need more and more energy. I mean, electric cars, the green revolution, AI data centers. I know, I say the AI bubble's going to pop, but then I'm looking at investments that involve AI data centers. But these AI data centers are still going to be built. Google, Amazon, etc. They've already signed contracts and they've paid to build these things. So they are going to be built. And when they are built, they will consume energy. So I'm looking at energy stocks like NextEra, ticker NEE, and Centrus Energy Corp, ticker LEU. That's a major uranium processor. Total Energies, this is a European company, ticker TTE, the only European super major that didn't cut its dividends in 2020. I'm going to be building a position there once it looks like it's bottomed. I don't think it's bottomed yet, but I could be wrong. Vistra Energy, ticker VST. They're a nuclear power. Well, they provide a lot of different energy solutions, but nuclear power is one of them, and I'm bullish on nuclear power. They secured a contract with AWS and a 20-year deal with Meta. Anyway, you get the idea. I'm heavy into Poland. I'm heavy into energy right now. I'm probably going to be selling my Polish stocks towards the end of this year though. But this so far is working quite well for me. So you don't have to be invested in the big boys to get good returns. You can get great returns investing in less risky stuff. Also, to be clear, any of these stocks I'm mentioning, I'm not saying to jump in right now. I built positions in these over time. Always look for a decent price to get in. Anyway, what are you guys looking at? Let me know, and I'll see you on the next one.